This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the third lecture on chapter 23 of the free lecture notes. And we're still talking about the consolidated statement of financial position. But the final problem is what we call inter-entity transactions. And I mentioned it briefly at the end of the last lecture, but remember that the two companies, the parent, the subsidiary, they are two separate companies. And it's quite possible, therefore, that one of the companies could have been selling goods to the other company. And that potentially creates two separate problems. The first of which I think is very easy to understand and very easy to deal with, but it's inter-entity balances. And to show you what I mean, look at example 6. Company P has a controlling interest in company S. So we do need a consolidated statement of financial position. And extracts from the statements of financial position of each company individually, as at December 2010, receivables, payables. Now, if it weren't for the one problem, for the last line of this question, what would we do? As we normally do. Receivables, current assets, you simply add up and we'd have 80,000. And similarly payables, part of current liabilities, we simply add up 75. Now that's what we'd normally do. However, if you read the last line, included in P's receivables is 8,000 owing from S, and obviously therefore S's payables include the 8,000 owing to P. Well, on the consolidated statement, we only want to show the amounts owing to and from outside the group. We don't want to show amounts owing within the group. And so receivables, that 80, because it includes the 50 P's receivables, that includes 8,000 from S. We want to remove it. Only 72,000 is owed from outside the group. And similarly, that 75,000 total payables, it includes S's payables of 40, and included in that 40 is 8,000 owing within the group to P. We need to remove it. And so the total owing outside the group is 67,000. Should have used my calculator. There we are, 67,000. So that's an easy one. If there's anything owing between the two companies at the end of the year, then remove it from total receivables, remove it from total payables. All right, well, that should make sense. I think that really should be an easy one to understand, and it's certainly an easy one to deal with in questions. The other problem, though, needs a bit more thought. And it's inventory at the end of the year, where one of the companies has sold the goods to the other company. Now, let me explain with a tiny little example why it's a problem, and then we'll do a full one. Just suppose P was selling goods to S. They sell to lots of people, but they've been selling some goods to S. Well, no matter who P sells to, they'll sell at a profit. Maybe they've got goods that cost them 100. They add on a profit of 20. And they sell them at 120. And obviously that profit will have gone to their retained earnings. As far as they're concerned, they've made a profit of 20. Suppose those goods were sold to S. Now remember, they are two separate companies. And so if P charges 120, S had to pay 120. And S adds on a profit, perhaps they add on 30. And so they sell outside for 150. So P sells to S sells outside. And so that 30 profit has gone to their retained earnings. Now there is no problem. No problem. When we come to consolidate, we add up the retained earnings in the normal way. 20, 30, 50, and the group has made 50 profit. The goods cost the group 100, and the group sold them outside for 150. There is 50 profit. But where we get a problem is this. Suppose P sold to S for 120, S pays 120, but at the end of the year, those goods are still in inventory. And so in S's own statement of financial position, they'll value those goods at cost, and they cost them 120. However, when we come to consolidate, there's a problem. Because any inventory we should be showing at cost to the group. And although S paid 120 for them, they only actually cost the group 100. The 120 includes P's profit. But if these goods haven't been sold yet to outside, then we should value at cost to the group. We need to take out that $20 profit. And the other problem, when P sold them to S, in their own statements, they made a profit of 20, and that's in retained earnings. However, for the group as a whole, that profit hasn't been made because those goods haven't been sold outside the group. And so as you'll see when we do a full one, when we look at the retained earnings for the group, we need to remove that 20 because the group hasn't made the profit. We've only made the profit if the goods ended up having been sold outside. So it's only a problem here when there are goods still in inventory that were bought from the other company, but we need to take out that profit that the group hasn't made. We call it unrealised profit. So let me show you with a full example. The last example in the chapter, example 7. P acquired 75% of the share capital of S on its incorporation, so they own more than 50%. We need to do a consolidated statement. You've got the statements of financial position of the two entities, and so both very much as normal. And in P's statement, investment in S at cost 15,000. At the bottom, during December 2010, we appreciate we're doing the statements at December 2010. So during December, S had sold goods to P for 6,000. And S is selling to P at cost plus 25%. S makes a profit. However, P hasn't sold any of the goods, and they're all therefore still in P's inventory. Additionally, P's not yet paid S for these goods, and so 6,000 is included in P's payables and S's receivables. All right, well, let's go through our normal workings. First of all, goodwill. Calculate this exactly as normal. The value placed on the business, as far as P is concerned, was the cost of the investment. Remember, they bought 75%, and the cost from P's statement is 15,000. To get the full value placed on P, we need to add on the fair value of the non-controlling interest. And I did tell you in the earlier lectures, almost certainly you'll be told the fair value. Here we're not, in which case we say, well, if 75% was worth 15,000, 25% will be 25/75 of 15,000, which is 5,000. And that actually makes sense because it was bought on incorporation. You wouldn't expect it to be worth more. So the value 20,000. What was the asset value of P, of S, I beg your pardon? It's S's share capital so from S's statement 20,000 plus any pre-acquisition retained earnings. But of course here there aren't any because P bought the shares on incorporation, so no retained earnings. And so the goodwill, of course, here happens to be nil. So here an easy one, but this problem with the inventories I mentioned doesn't affect the goodwill at all. We've done enough calculations of the goodwill in earlier examples, and again the approach doesn't change. What about the retained earnings for the group? Well, what do we normally do? Normally it's all of P's, which is 30,000. And as far as the subsidiary is concerned, S, it's P's share, 75%, of their post-acquisition retained earnings. Well, P's retained earnings are 15,000. Because, I think I said P, I meant S. Anyway, S's retained earnings are 15. Because P acquired the shares on incorporation, there were no pre-acquisition earnings. These are all post-acquisition. And so normally we just take 75% of 15. However, here's where we have to think about this inventory. Because S had been selling to P. Anything they sold to P, they'd made a profit on. That profit is included in the 15. But if the goods are still in inventory, we sold them to P, if P's still got them in inventory, then the group hasn't made that profit, it needs removing. And so we need to do our workings, what we call the provision for unrealised profit. Or the PERP. We need to calculate on what's left in inventory how much profit is included that S obtained because they'd sold goods to P. What's happening? S had sold goods to P for 6,000 and S is selling at cost plus 25%. Now, assuming you've watched the lecture on markups and margins earlier, this should be easy, but let's check. You see, it means that anything S sells, if it costs them 100, they're adding on 25%. They're selling at 125. So everything they've sold for 125, they make a profit of 25. Well, they had sold goods to P and left in inventory were all of them 6,000. So that's how much S had charged P. That's how much P, how much it was costing P. But S charged that much. It includes this profit. The profit is 25 for every 125. And therefore it includes profit of 1200. And of course it does check. Don't waste time in the exam, for heaven's sake. But you see, if it's charged 6,000 and it cost 1,200, the profit was 1,200, it'll have cost them 4,800. They've added on 25%, which is 1,200. And they charged P 6,000. Well, S will have included that profit in their retained earnings in their own statement. But because these goods are still in P's inventory and haven't been sold outside, the group can't record this profit. We need to take the 1,200 out of S's retained earnings, because it's S who'd sold the goods, it's S who'd taken the profit. And so the profit we can take, 15,000 minus 1,200. 75% P's share is 10,350. The group's retained earnings, therefore, 40,350. The final bit of the standard workings is the non-controlling interest. And how do we calculate this? If you remember, we take the fair value at the date of acquisition. And as I've kept saying, normally you will be given it. Here, though, we calculate it. What do we get? The fair value? 5,000. And we add on the non-controlling interest share, 25%, of the post-acquisition retained earnings. Well, because P bought the shares on incorporation, all 15,000 were post-acquisition. But again, we need to remove the unrealised profit, the profit on the goods that are still in inventory. We calculated it above, it was 1,200. And so 15,000 minus 1,200. 25% is 3,450. Now we've done our workings, and in a minute I'll do the consolidated statement, and that shouldn't take very long, having done the workings. But let me stress two things before I do. One is this unrealised profit is only calculated on goods that are still in inventory. P had bought goods for 6,000 from S. If those goods had all been sold, absolutely no problem. We don't need to make any adjustment. If half the goods have been sold, no problem on that half. It's only the other half where we'd have to look at the unrealised profit. If only half the goods were still in inventory, they would have cost P only 3,000. The unrealised profit would be only 600. Secondly, and be careful here, we need to take out the unrealised profit. We need to take it out of the retained earnings. You take it out of the retained earnings of whichever company sold it to the other. Here, even though it's P who's still got the goods in inventory, it was S who'd sold them to P, So we took the unrealised profit out of S's retained earnings. Had it been the other way round, had P sold the goods to S, then it would have been P who'd taken the profit, and therefore we'd remove it from P's retained earnings, not from S's. If P had sold them to S, P's retained earnings are reduced by 1,200, S's we'd take the full 15,000, and similarly, the non-controlling interest, you'd take the full 15. So again, you calculate the provision for unrealised profit. You subtract it from the retained earnings of whichever of the two companies sold to the other one. All right, finally though, let's now do our consolidated statement. I'm still on the wrong colour. Here we go. Consolidated statement of financial position. Non-current assets. Always just add together 50, 25, 75,000. Remember, the only time we'd adjust that, if there was an adjustment for fair value, we'd add it on to 75,000. Goodwill, arising on consolidation. If you look back here, it was 0, but you know how to calculate it, you know where it goes. Inventory, basically add up, so 13,000 in P and 7,000 in S. But remember that 13,000 in P will have been at cost to P and will include those goods they bought from S, which had cost them 6,000. However, that includes this unrealised profit. Take out the provision for unrealised profit because they should be valued at cost to the group. And so what does that give us? 20,000 minus 1,200. 18,800. Other current assets. P 10,000. S 6,000. However, these include receivables. And so, nothing to do with the inventory. Do receivables include anything owed from one to the other? Well, yes, they do. Because P hadn't paid S for the goods, P's payables include 6,000, S's receivables include 6,000. And so, included there is 6,000 owing from P to S. The amount owed from outside the group, 10 plus 6 makes it 10,000. So the total, $103,800. So do I do that? Yeah. What about equity and liabilities? Share capital. We've done enough times. It's always simply the share capital of the parent company, so 45,000. Retained earnings. We've done our workings. And what was it? 40,350. And so the total owing to shares in the parent company, 85,350. But of course, we brought in the whole company and part of its own owed to the non-controlling interest. And again, we've done the workings for that. And what did it come to? 8,450. Finally, current liabilities, 13,000, 3,000. But of course, this includes payables, and included in P's payables is 6,000 that's still owing to S. So take out anything owed from one company to the other, and what are we left with? 10,000. Does it add up? I hope so, but let's check. 85,350 plus 8,450. 103,800, and there we are. All right, so overall there's a lot involved, but it's certainly just about the most important topic in the exam. And we've got everything there for paper F3. All right, when you come to F7, things can get more complicated. You know, there won't just be 2 companies, there could be 3, 4 companies. But for paper F3, we've got everything there from the Consolidated Statement of Financial Position. It's up to you, I'm afraid, to go back, rewatch the lectures as much as you need, and then practice and practice and practice. However, although that's the Consolidated Statement of Financial Position, you'll see the next chapter is Consolidated Statement of Profit or Loss. We need to do one of those as well. However, you should find that actually a lot easier. But anyway, we'll save that till the lectures on the next chapter.